Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
First weekend of the new month, and there you have it. Weekly market recap as for the first week of February. Pretty volatile week, as we've seen. Why not? I guess we need to get used to the fact that from here on out, these bombshells will be dropped on the market right around Friday close or throughout the weekend. So we might get to wake up on Monday every single time seeing the markets going higher or higher. But hopefully it won't last long so that we can have very relaxing weekend, but we'll see, right? Um, let's have a look at the economic calendar. We knew there were many different data points coming in, especially for the labor market. But Monday started out with ISM manufacturing PMI. They ticked up a bit. It's not a huge deal in my opinion, especially because this is the first time it ticks to the upside after what? Well, basically since December 2022, essentially. So, I mean, all these enthusiasm about, yeah, now we got Trump, he's going to make America great again, and that should be reflected in our domestic industrial and manufacturing sector. Yeah, I mean, it's just one data point. I would give it at least another six, so another 6 months before starting to pop bottles of crystal, right? But anyway, it's still better than being negative, of course, right? But then we start to see bad data coming in. The jolts, so job openings, they were below expectations and below the previous data. And of course, the trend, it's still to the downside. So again, the labor market, is it resilient? Is it not? Right? Maybe you should ask Jay Powell. Although, I mean, he's been particularly vocal in saying that he thinks that it could be overestimated. Anyway, IDP, non-farm employment change, again, came in kind of in line with previous data points and above expectations. So what do you make of it? Good? Yeah. Headline is good. Trend still down. All right. Then you get to ISM services PMI, and they came in below expectations, still in positive territory, considering this is a diffusing index, right? So everything above 50, it's considered to be an expansion phase, and when you see it below 50, it's a contraction phase. But I mean, 52.8, expected 54.2. The previous was 54.1. Again, it's nothing major, but still, the trend is not particularly enticing. And this is one data point which, in my opinion, counts more than the manufacturing sector because of what we always say. The US economy, it's 70% consumption. So I guess services play a bit of a more important role in it. Quickly jumping into Europe, we've seen what Bank of England dropping rates finally, just 25 basis points, but it was, I mean, it might be a start, right? They got in line with all the other major central banks like Canada, Switzerland, the ECB, and all the rest. So we'll see. Then we get to the juicy stuff, right? Uh, look, the average hourly earnings came in higher than expected and higher than the previous rate. Which, I mean, in and of itself, you look at this data series and you think, well, see, I mean, at the end of it, it looks like people are making more money. Or at least, if you look at the trend over the last 2 years, they are not losing a lot of money when it comes down to their hourly wage. Yeah, okay, you might say that, but there is more to it in my view, all right? And the big one, NFP, which came in a bit below expectations, and of course, massively below the previous data point, which was revised up to 370K. All right. So then we got unemployment rate, 4%, tick down 10 basis points. Not a massive change, although, again, there's more to it, to these labor market data points. We're going to get to it in a minute. Uh, Michigan Consumer Sentiment Index, tick down, below expectations, below the previous one. All right. And the part of the index, as for the inflation expectations, that actually pushed to the upside pretty much. So again, I guess there's still this controversy in between inflation expectations, but what the other part of the data set are actually telling us. Mainly, I guess it's driven by narrative and all this discussion around tariffs. I'm not going to talk about tariffs a lot because it would deserve a video on its own because it's a huge topic and I don't want to spend 30, 40 minutes talking about it. But still, I would say it plays a role. Now, um, let's get back to it in a minute. Just, for a minute, just to highlight a few points before getting into the charts. When you look at this data, as for the labor market, you might think those are all positive, especially, we started out with average hourly earnings. But then, if you check something like the amount of hours which were worked per week, aka the average weekly hours, you see that that metric it's down to 2020 levels, which is not good. Like at the end of it, you might also say, yeah, maybe you are earning slightly more, or let's say you didn't lose purchasing power, quote unquote, as for the money you make for every single hour you work, but you worked less hours. So on net balance, you're making less money, right? It's not good if the hourly earnings remain particularly stable, but at the same time, the number of hours you work actually tick down. That's not good. It means that you're working less, and therefore, overall, you're making less money as an employee, right? So that's the first thing we might want to check in order to assess the conditions of the labor market, right? But then, of course, if you get back to NFP, the data point in and of itself, it wasn't particularly bad. I mean, as we've seen, it starts to look a bit grim if you compare it with the previous month's revisions. Like, December was revised higher up to 370K, and even November was revised higher. I think it went from 49K up to 260K or something like it. So, uh, I mean, is it a seasonal factor because of the holiday seasons, and so you need to hire more people to face the increased demand over that period of the year? Maybe, maybe not. But the real problem, in my view, it's the fact that throughout this period of the year, you see many statistical and seasonal adjustments made to the data, mainly by the BLS. And that's where the thing gets really controversial, all right? Because if you check, although, the upper revisions for November and December, and although the numbers for January weren't that bad, not spectacular, but not bad, then if you check what they said about the year 2024 as a whole, you see that employment increased by roughly 2 millions, averaging 165K jobs per month. But that is still lower than the previous projection, which they were around 2 point something million on average, and a monthly gain in jobs created of 185K, I think. So again, on a year-over-year base, you see that at the end of it, we missed expectations, so to speak. So again, it's not really cool. Then you get into the huge rabbit hole about how these data are actually calculated. Now, of course, you know that in order to get to unemployment, you not only need the job numbers, you also need to relate them to the workforce. And so the participation rate gets into play. Now, in order to get there, you need to know, the first thing to know, it's the amount, I don't want to call it exact because it would be disingenuous, but you need a good approximation of what the population of the country is. And that's what you got the Census Bureau, right? So the Census Bureau, of course, as many other different agencies, provides data which are very lagging in nature because, of course, they need to run them, they need to run the surveys, and then they can come up with a data set which could be considered or not accurate, right? What happened is the Census Bureau actually revised the population numbers higher, and therefore from there it starts a huge path of adjustment as for the employment rate. Okay. The bottom line is, without getting into the math and the statistics and all the smoothing, but what happened is, well, yeah, the the census actually revised the numbers higher, and therefore the BLS did the same based on the new data set provided. Right. Now, I don't want to get into conspiratorial type of topics because I've seen they have estimated new people coming in and around 2 point something millions, and you would start to wonder, really, throughout 2024 only 2 millions people crossed the border? I don't know. There was a lot of discrepancies there. They were also kind of dividing it by ethnic. Turns out half of the immigrants were actually white people. Yeah, okay, pull the other one. But anyway, at the end of these adjustments, you've seen the the entire data set shifting to the upside. But although you might shift the entire, let's call it curve to the upside, that doesn't necessarily mean that the ratio it's going to increase or decrease. So it's going to look better or worse. In this case, it looks kind of the same. And at the end of it, what you might get out of it, it's just that, yeah, maybe assuming the data from the census are correct, there might be more people in the country and there might be more people working, but the labor market is still in the same crappy conditions if you look at the ratio in between these two values. So the problem is always, as we've seen in the past, the hiring rate, which is declined. And if you remember the quit rate, that declined as well. So again, less people quitting the jobs because they don't think they can find a better one or another one. Companies are hiring less, therefore the labor market is particularly stagnant. Or in Jay Powell's words, resilient, stable, cool down enough, right? But again, when you compare these numbers, after all the mambo jumbo, the math and statistical adjustments, you simply look at the baseline that you had as for payrolls coming off 2010, so basically after the GFC, we have been constantly and consistently lower that, below that, which again, it just tells you that over a long enough period of time, you're starting to talk now more than 15 years, it looks like, believe it or not, we never really recovered from the GFC, or at least, the US didn't really recover. And, if you add on top of it the fact that most of the new jobs created recently in recent years are not full-time jobs, but part-time jobs, then you start to get an even worse type of assessment of the old situation. Because think of it, what do you think could get you more, safety, confidence, stability? A part-time job or a full-time job? Now, I'm not particularly sure, but I do think there are also benefits, advantages when it comes down to having a full-time job against a part-time job. And overall, would you say having just one full-time job, it's what do you think? Is it better or worse than having to seek for two, three, four part-time jobs just to make ends meet, right? So again, it's not cool. No matter how you cut it and slice it, it's not cool. Especially because when you think about the earnings, the hourly earnings, the jobs, full-time versus part-time, at the end of it, all of it translates in confidence. Confidence translates in sentiment. Sentiment drives, more often than not, drives spending. And there is no spending, there is no economic growth. And as a matter of fact, if you look the relationship in between the full-time workers and consumption and inflation, you see there is a clear relationship, and it's not going the right direction for now. So again, that's just another thing to check. Sure, it's not going to impact markets right away. It takes a lot of time, but sure enough, it impacts the real economy. This is why I wanted to dedicate at least 10 minutes to it just to clear the air a little bit. All right. Overall, the ultimate effect is that if you check the percentage of GDP, which is represented by uh, price and consumer expenditure, so PCE, well, you see that the more the debt went higher, the more the household debt went higher as a percentage, of course, of GDP. At a point, it just stopped. Guess when? Right around 2008. It's like, although they won't admit it out loud, but it's like the American population, and not only the population, maybe even the banks, right? If you look at loans and credit conditions, right? They kind of reached a peak where they said, wait, so we can't just keep on taking on debt and increasing our standard of living, because we've seen what happened when we do live above our possibilities. And we didn't like that deleveraging event for sure. So I know it's sad to think about it, but overall, you could even call it some sort of a depression. What do you call it? An economy which cannot grow at the same pace it was growing before. And the silver lining there is that the US economy, it's the one which is defending itself better compared to all its peers throughout the rest of the world. So I guess, just something to think about. Now, after that, and I know a lot of people are probably already quit, but let's get into some charts, shall we? So let's start out with the DXY in a weekly time frame. We see that nothing really changed. We are still trading in this dealing range for now. You can also zoom in on a daily time frame, and you see that it's basically still there. Got a drop, then a spike on Monday, of course, and then it drew back again to the lower side of the range, but it didn't break to the downside yet. Now, maybe if I remove the 10-year yield, it's even better, right? Yeah, as you can see, not a lot of movements in currencies. So even if you check the euro, the pound, they are now trading in a little bit of a range, going sideways a little bit. It's not enticing. I mean, I'm not seeing it as a particular sign of strength for the euro or the pound. I did like the dollar Canadian a bit more. Like you've seen these massive spike to the downside uh, starting out the week because of the trade war, and then it immediately jumped back up. It looks like it reclaimed the previous dealing range. So I mean, when you see these movements where price goes sideways, it got a massive movement to one side, and then it completely revert the entire dynamic, and it gets stable above the previous dealing range. That's usually a sign we might see a bit of upside. Now again, on a macro scale, maybe not a lot. I still consider the DXY particularly strong, but maybe a bit more of upside getting back around these levels, and then we'll see where it goes. Um, the Japanese yen, curiously enough, kept on grinding to the upside, and actually Tuesday, Wednesday, particularly good days for the yen. Um, the problem with the yen, again, it's not really about the direction overall. It's the rate of change because of the yen carry trade and whatnot. So it might move to the upside up until the point you don't see it spike like it did in July, August. That should be controlled, right? So again, you can keep on monitoring, and what you really should pay attention to is the potential spike one way or the other, especially to the upside because of the dynamics of the carry trade. The bricks, well, a little bit of one and the same. The ruble, it's getting a little bit of attraction right here. Indian rupee, it's still fucked, like absolutely fucked. This currency is collapsing, really. Chinese yuan giving back a lot of the gains after the DeepSeek type of debacle and then the trade war. I mean, I know China took a bit more of a strong stand against these tariffs, and they said they're gonna respond by hitting what, maybe Apple revenues or maybe the Google search services in China. Yeah, maybe will it work? Don't know. I mean, I'm of the idea that a trade war, it's not a benefit for no one involved in it, but I still think China has a lot more to lose than the United States. That doesn't mean that a trade war wouldn't hurt the United States as a whole or the American consumers. I'm just saying China and Chinese consumers might actually be hurt even more than that. So if it is a race to the bottom, and if we are talking about, yeah, I mean, I know we are all going to suffer. I just know that you're going to suffer more than me. And so you're going to have to throw in the towel long before I do. That's how I win this quote unquote war, right? Let's move on to gold. Uh, Gold kept on going higher. Again, there was a little bit of a spike to the downside on Monday. It's a bit of a constant. We're probably going to see it on many different assets this week. But overall, it kept on grinding to the upside, still above the previous all-time highs. I don't really see any particular issue with gold. We touched into the 2,900 level on the future. We are getting close to big figure, psychological level, 3,000. So again, you know how the market likes to treat these big psychological levels. Might see a bit of a volatility spike, and or I mean, usually, oftentimes you either see a front run of the level or a completely overshoot. It's kind of rare that we stop right at the level. It could happen, of course, but maybe what I'm trying to say, it's just it wouldn't be a bad time to book in some profits if you have it, right? But other than that, nothing in particular with gold. It's still going to the upside. The fundamentals reason are always there, so nothing new. Don't need to spend much time on it. Okay, let's have a look at Bitcoin. Um, Bloody Monday for Bitcoin, but it was pretty much recover throughout the same day. I remember when I was recording the video last week, we were trading pretty much at these levels, around 102K. And I said, well, if we can crack this level, we might go a little bit of a downside move, but I don't expect it to break this dealing range over the weekend, which, to be fair, turned out to be true because on a Saturday, basically 2 hours after I finished to record the video, it closed below. Next day, Sunday, I came back up, wicked into the level, just broken, and it went down. It bounced right around this level, so we could technically say for the weekend it held, the range. And then on Monday, of course, it was what it was. Curiously enough, the huge bounce wasn't able to regain the previous level highlighted throughout the weekend. And of course, from there, we dropped even more to the downside. Now, uh, we are still hovering around this area. I'd say again, the best thing at this point, if you want to keep on being bullish in the very short term, would be maintaining these levels over the weekend and see if we can have a little bit of an upside push on Monday, Tuesday next week. Uh, but it's also true that if it stalls at these levels a lot, that could also mean weakness. So if it really fails to reclaim it, you might see even lower prices. How much lower? I don't know. This week, this shadow might be targeted, but we are getting back to the same game. How much liquidity could be left over below these lows? It's always the same game. And as usual, since it's always the same game, I must say, up until the point I don't see a decisive close below these levels, I'm not gonna I'm not gonna call for humongously lower prices, right? The range is the range until the end of the range, right? Let's move on to oil. Oil came down, and I mean, again, if you check the videos from 2 3 weeks ago when oil was spiking to the upside, and I was like, yeah, I mean, I usually follow the break evens, but in this case, which if even if you check them now, they would suggest higher inflation expectations, therefore justifying higher oil prices. But if you remember what I said, it was, yeah, maybe. I mean, I know that's how you use the indicator in this context, but I still think fundamentals might might actually overcome it. And lo and behold, oil came back down from 80 to 71, basically. And you remember last week we were just trading below this level. You see the fail, reclaim, and down it goes. So I think it's gonna stay here for a moment. I'm not I'm not particularly sure it's gonna drop out of these levels so quickly. And even if it does, you might find a bit more of a support down here for an intra-week bounce, maybe. Um, I might say it could keep on trading sideways for a while, maybe a few spikes to the upside, a few attempts to push a bit more, a bit deeper into this level right here. But I would still be kind of neutral on oil, with the caveat that overall, on a macro scale and from a fundamental perspective, I see it, let's say, not so strong. Does it mean it needs to crack these levels and go back down below 60? Um, maybe not. I mean, I think the huge drop in oil would come if you got clear signs of a recessionary outbreak in the US. Up until that point, I still think it's going to do what it did for over the last 2 years, trading sideways, spiking up, spiking down, and then always mean reverting. That would be my take on it. Okay. Now let's check the yields, which of course came down a lot. Tuesday, Wednesday, a bit of a bounce on a Friday to close the week, but overall, it wasn't um, a substantial move. Talking about the bounce. Now we'll need to see what's going on if we got a rejection at these levels, or if this was actually in a higher low and yields are gonna keep on moving to the upside. My honest opinion is that I don't think so. Again, I made the case for lower yields into the future many, many times, and I don't want to sound like a broken record, although I do. Um, but I've always said it takes a lot of time. Uh, it might be a bit like oil up until the point you don't see that quote unquote exogenous event where everyone completely shift from thinking, yeah, well, inflation is going to be higher, so rates need to be higher. No, wait, uh, that changes everything. No more higher rates, no more higher inflation. We need to reprice everything. Uh, at that point, you see sharp moves coming into this market. Now, bear in mind, rates they don't move a lot. If you check, having something like this on the long end of the curve 10 basis points, 11 basis points in a day, it's not something you see really every day. So you might see them spiking one way or the other, as you have seen them doing in here. But always remember, as any other thing, everything which goes up quickly needs to cool off and draw back the leg, at least to some extent. All right. So keep on monitoring rates, but I'm not expecting a lot up until the point we got some substantial news on the inflation side or the labor market side at this point, right? Conversely, ETFs, as you've seen, TLT got back into resistance and it was rejected on a Friday. Um, Good place to take profits, to be completely honest, especially if you were long from here. So, yeah, nice move there. Well played. um, Still, you might say we reclaim this overall level and now we might grind to the upside. Yeah, I I told that story many, many times, and so far it turned out to be false. So I'm gonna be a bit more prudent this time around and a bit more realistic and say that you need to assess this market as it goes. You might have your fundamental thesis, but from one week to the other, you might see many different movements. I'd say, for now, the best thing for these assets, if you want to have a bullish stand on it, would be maintaining this range. I'm going to take the TLT as an example. Okay. If you can maintain this dealing range here, right? Trading in this range for a while, consolidating, kind of reaccumulating, and then push to the upside, then okay. If you see it immediately shifting to the downside and shit in the bed right away after this rejection, then it's no cool. And most likely at that point you see rates on the other chart keep on grinding to the upside. But for now, for next week, again, I'd be on the neutral side for this asset as well. We already got the move, I don't want to say the move of the month, but we already got a huge move, a substantial move. So I would give it a little bit of a period to cool down, kind of like it was in here, right? Move to the upside, cooling down, move to the upside, cooling down, move to the upside, maybe cooling down, right? So we'll see. Um, Before getting into stocks, I think we need to discuss one tiny little thing. All right, just briefly, but we need it. Now, look, everyone is talking about tariffs, and although I said I'm not going to dive into it a lot, but I think it might be sobering to look at the last iteration of uh, a trade war, essentially. Now, probably it wasn't as severe at this time around it could be, considering Trump's claims, but at least it might be a little bit of an insight, right? So, in order to get that, we just need to go back in time to 2016, 2021, 2017, 2021, basically the last Trump term. And what you see is that basically throughout his last term, that was a period of 2 years while we got some sort of a trade war. Now, that time around, it was only against China mainly. And if you look at how the stock market behaved throughout that period, at the end of it, you didn't really see a crash. it was mostly in a dealing range. Now, it's true that in 2018, we had a little bit of a pullback. Well, I mean, it was a substantial drop overall, but there is a good difference right there. Look, you might get a trade war now, but differently from 2018, now the Fed is not hiking rates. Back then, they were hiking rates. And I know that in and of itself, it says a lot, it says nothing. What matters for you is just that the market thinks that high hiking rates it's bad for stocks, and cutting rates it's good for stocks. So though you might see a trade war with China and with other countries potentially, it's not a guarantee that we are going to have a crash just because of it. So try to tune down your expectations one way or the other. All right, because the last data available we got says that it was a little bit of a long dealing range, and the market didn't go one way or the other for a long period of time, or a long enough period of time. Okay. Now, it is also true that if you check, for instance, the VIX throughout that period, well, the VIX was substantially higher, and it spiked many times to the upside because, of course, uh, these situations, these geopolitical tensions, they do create uncertainty. And if you check the past examples, we got tariffs on steel and aluminum. We got tariffs on what? I do remember the example of the washing machines, right? And people said, yeah, but you see the washing machines, what price of washing machines actually went up. Yeah, I mean, if you impose tariffs on washing machines, since it's a tax, of course they're gonna go up. But what did inflation do throughout that period overall? Did we have inflation spiking up 2, 3, 4, 5%? No. As far as I can remember, we didn't. So take this situation as a situation of uncertainty. And as we said, uh, it could be that you get a lot of volatility, but at the end of it, the market just stays stable. What's gonna influence the market as for the price action? It's gonna be capital flows, right? And liquidity as usual. So if you really wanna predict a crash or a serious downturn in the stock market, well, just check liquidity availability. It could be the repo rate, it could be credit spreads, it could be the DXY, right? Because of course, if the dollar spikes to the upside, that's gonna drain liquidity out of the system, especially outside of the United States. So that could be one. And if that happens, you're gonna see all the others, the rest of the world, which will need to liquidate assets in order to get dollars. And since we got a lot of inflows or capital inflows from the rest of the world into the United States, well, if the foreigners start to liquidate those assets, they sell. Therefore, price of stocks and equities might come down. But other than that, I wouldn't read a lot into it. So let's have a look at what stocks did. Now, pretty much, they opened down on Monday, as we said, spent the rest of the week trading to the upside. NQ got back to the same levels, or at least the recent local highs, and it dropped once again. ES futures, they came in a bit lower than that. Um, so again, I think this might be another rotation. As for the Dow, still in this dealing range. Same for the Russell. Why do I say rotation? Well, because if you check the sectors over the last 5 days, you see that the most hit was the consumer discretionary, while technology, believe it or not, actually catched a bid. Not a lot, but a bid. Industrials were a bit weak. Healthcare was a bit weak. And again, if you remember the NFP report, a lot of jobs were actually added in healthcare. So could be, healthcare was beaten up, got a little bit of a relief, and then it was beaten up once again, while technology was beaten up previous week, and now we're seeing a little bit of a relief in that. Um, Bear in mind, we also got a lot of earnings this week. Like we've seen Google selling off after earnings because it disappointed for a few $1 million, which again, when you say it out loud, it sounds strange, but we are talking about forecasted earnings and actual earnings in the order of billions. So, a few millions here and there could make the difference. Um, Same with Amazon. Yesterday, Amazon sold off. The guidance wasn't particularly cool. They also actually they missed revenues, maybe, I guess. But again, you see these earnings, they didn't really come in at the top of their A game as it was in the past. So could this be a potential sign of weakness in the stock market? Maybe. I mean, we were also checking the fact that February, historically, it's not a very strong week, especially the second part of February. So we'll see about it. It's just seasonality. It might be completely different this time around, but when you got a statistic to go off of, why would you ignore it? Uh, Overall, if you check the ETFs, it's kind of the same of last week. Sharp drop, recover, close the week above the 21 exponential. Same here. Maybe the Q is not really above it, but right around it. It's a lot of chop. Again, we are getting what we were expecting, a lot of choppiness and intraday volatility and whatnot. And look, I mean, this is not an easy market to trade, to be fair. I mean, yeah, if you are one of those med scalpers, yeah, well, then you're having a lot of fun, I guess. But if you're one of those guys which are trying to get into a position and ride it for a session or a good chunk of the session, yeah, well, maybe this is not the market for you. I know because I'm kind of in the middle. I'm not a pure scalper, but I don't hold trades for 1, 2, or 3 hours either. I just trade it from point A to point B. And sometimes it's hard because over the past 2 weeks, you get into a position. You might think the market goes for like 30, 40, 50 points. Piece of news comes out, or maybe just the announcement that Trump it's gonna make a press conference in 2 hours, and the market drops like 30 points in 2 minutes, and you're like, I was almost a target. So yeah, you need to be nimble in this market if you day trade, but that doesn't mean that you don't get opportunity. Actually, I mean, it was a good week at the end of it. It was just, you need to just readjust your expectations and therefore your behavior in these markets. That's it. Do you want to check real quick just the Max 7? Nvidia came back up, double tap into support, and now double tap into previous support, then flipped resistance. We'll see. I mean, as I said, although many people might already give Nvidia for doomed, I don't think that's the case. Apple, after earnings last week, we've seen the down move and so far didn't recover. Google, as we said, earnings disappointing, which sounds strange when you say it, but these companies are money printer machines, but yet the market can be disappointed just because you miss by a few pennies. quote unquote. I mean, I get the logic. It's all about expectations. Why not? And it's all about, many different factors: the capex, the cash and cash equivalent levels, the guidance, many different things. The point is, when these assets are priced to perfection, it doesn't take a lot to ruin that perfection, to cast the spell away. All right. Microsoft, kind of like we were talking about last week, it might be we get down into the 380 level throughout this month, considering the seasonality, right? Maybe. Meta instead, it's doing good, still grinding to the upside. Amazon, of course, we already discussed it, down, not a lot into it. Tesla dropped finally. So that's it for equities. Look, at the end of the day, let's keep this video short and let's just cut it right here. As you've seen, there is not a lot going around. I mean, news coming in. You can, if you want to make a recap, the labor market keeps on confirming it's not as resilient or as strong as someone would like you to believe. Stocks are still in a trading range, and probably you're going to have more chop ahead, especially for the month of February. Pay attention to what the news stream is, and especially pay attention to what comes out of Trump again. But also bear in mind that many of the things he said, they might be like X on Monday and turning out to be Y on Wednesday, and the market completely reversed. So just get used to the volatility and the mean reversions, because I think we're going to see a lot of them. Uh, Not only in February, but I think throughout the year, right? That doesn't mean the year is going to go bad. That doesn't mean the stock market is going to crash. We might just have a particularly bumpy road ahead, so to speak. All right. Other than that, I wish you all a good rest of your weekend and a good start of a new week. And as usual, be nice and be cool. And most importantly, in this market environment, be safe. Needs out.
So, what you're telling me is that the music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.